Um, for me, the core holding is gold, simply because this is getting out of credit. This is the way central banks are doing. They're accumulating gold for exactly the same reasons. And every time you see the Bank of China, the People's Bank of China, buying gold, just think it through. They're not buying gold, they're selling dollars. I mean, they're getting out of fiat. It's as simple as that. So that would be very much my core holding. In terms of what might move with it, it's worth noticing that a basket of base metals, if you look at that basket's value in gold, it has declined by 80% since the year 1900.
Though gold dominates central bank reserves, silver's connection to money is centuries deep, from ancient Rome to Britain's long-running silver standard. Today, as trust fades in paper currency, investors increasingly treat silver as an affordable gateway to precious metal ownership. The gold-to-silver price ratio remains historically elevated, suggesting silver is undervalued. Should the ratio fall closer to prior norms, near 40 or even 30, silver prices would surge dramatically. A rising price doesn't discourage buying, it attracts more participants who fear missing out. Silver may therefore defy typical supply-demand patterns and strengthen as confidence in currency weakens.
If I am right and the value of credit continues to decline and we get a crisis, if you like, in the value of credit, then that is going to create demand for not just silver, but other commodities. It's bound to, because their prices will rise measured in declining credit. Silver has this additional factor that traditionally it has been regarded as money. I mean, we were on silver standards going way back, really over the last 2,000 years. In Britain was on the silver standard from the time of the Norman Conquest in 1066. So you can see that this is it's either gold or it's silver. In fact, actually, when the Romans first defined the difference between final settlement and credit, which was 448 BC in the 12 tables, money at that time was a bronze coin weighing one Roman pound. So, these things have shifted. But I think it is true to say that silver is still regarded as a form of money, as it were. Secondary to gold, very much secondary. The central banks don't buy silver. I mean, certainly not for their reserves. I mean, they may accumulate silver for a sovereign wealth fund, which is a very, very different thing. But what it does mean is that as confidence in fiat currencies declines, then that gold-silver ratio should also decline. And I don't think we get back to the level at which Sir Isaac Newton fixed it in the 1700s, which was a ratio of about 15.5 times. But I can certainly see in these conditions, these currency conditions, as they continue to evolve, I can see the gold-silver ratio falling, certainly below 50, probably below 40, and a reasonable expectation that may eventually go down to 30. Because bear in mind that as people awaken to what's going on with the currency, and it's not prices rising, it's the currency falling, more and more people will gradually understand that. And as they understand that, they will get out of currency into silver. And a lot of them will view silver increasingly as a cheap way into gold, which they may say, I can't afford to pay $4,000. I can't afford to pay $5,000 for gold, but I can afford to pay $60 for silver. So you can see that I think in a sense, it's creating its own demand. And this is the sort of good which the more it rises, the less people will sell it and the more people will look to buy it. So it will do the reverse, if you like, of a conventional supply and demand theory, which you see graphically represented in economics classes. So I think this is potentially a very, very different situation.
Silver is essential to high-tech industries, solar panels, batteries, advanced electronics, and growing medical applications. Renewable energy expansion has boosted consumption to near-record levels. Even if economic strain forces some innovation to reduce silver use, the baseline demand remains strong. But the next major driver may be monetary, not industrial. As inflation pressures and fiscal instability mount in the US and Europe, individuals and funds add silver as a wealth-preserving asset, a role industrial metals normally don't fill. With dual sources of demand and limited mine growth, silver could face a supply squeeze that accelerates price appreciation.
I think it'll basically be monetary considerations that do it. I mean, you're right to mention industrial demand, which is really off the scale, particularly with this, climate change stuff and photovoltaic sales and all the rest of it. I think as the price rises, they will probably manage to do with less silver, if you like, in photovoltaic cells. That they will innovate in that sense. But I think also that story is probably going to decline because as Western economies suffer from a fall in the purchasing power of their currencies, I think it will be seen that policies to do away with fossil fuels are economically destructive and just cannot be afforded. So in a sense, I would expect industrial demand to decline below where you might think it would be. But I think the difference is going to be taken up by monetary considerations.
Central banks aren't speculating. They are escaping currency risk. China continues to convert dollars into gold reserves, signaling a long-term strategy to reduce reliance on the U.S. financial system. Gold has outperformed commodities for over a century, preserving value through inflation cycles and wars. Base metals remain underpriced in gold terms, down roughly 80% over 120 years, indicating room for a broad commodity revaluation. Yet silver and industrial metals are considered speculative relative to gold's monetary dominance. For individuals seeking resilience in a monetary reset, gold remains the cornerstone of wealth preservation, not speculation.
For me, the core holding is gold, simply because this is getting out of credit. This is the way central banks are doing. They're accumulating gold for exactly the same reasons. And every time you see the Bank of China, the People's Bank of China, buying gold, just think it through. They're not buying gold, they're selling dollars. I mean, they're getting out of fiat. It's as simple as that. So that would be very much my core holding. In terms of what might move with it, it's worth noticing that a basket of base metals, if you look at that basket's value in gold, it has declined by 80% since the year 1900. And in my Substack research, I produced a chart which showed this effect. Now, if gold is, if that long-term relationship in gold between gold and commodities is true, and yup, it certainly is, then base metals are very much undervalued, and if you like, in fiat currency terms, as well as gold. So that is likely to push up, as that's corrected, is likely to push up base metal prices very, very significantly. So they could actually outperform gold. But since we're looking at currency risk, fiat currency risk, and that is what you've got to get out of, I would say that running out and buying, say, copper or whatever, if you can do it, is a speculative play. Silver is also a speculative play compared with what should be your core interest, which is gold, which is being accumulated by central banks, is owned by central banks, and will continue to be accumulated by central banks, and will form the basis of future monetary stability. We will always return to that. So really, gold is the core holding. I would say to anyone who is looking to escape out of the current situation, stop thinking like an investor. Just think about preserving your wealth, not accumulating it. And I think that's the key which everybody should take away from this.
Recent behavior reveals a shift in psychology, from waiting for dips to buying before prices rise further. Mints worldwide, including Australia's Perth Mint, have reported cleanouts of small bullion products. In nations like India, Thailand, and Vietnam, Lines form outside dealers as citizens seek protection from weakening local currencies. Bitcoin and other digital assets have also awakened public awareness to inflation's erosion of savings. While smaller retail buyers can fuel short-term volatility, their collective demand reflects a clear trend. Everyday people no longer trust their money to hold value. That sentiment rarely reverses once established.
I think that the retail buyers of gold, basically, they sort of, I think they've been alerted to the declining purchasing power of fiat. They would look at it as monetary inflation, if you like, but it's credit inflation, by Bitcoin. I mean, and they see Bitcoin has risen from virtually nothing up to $110,000 or whatever it is today, round about that. And I think this has alerted quite a lot of people to the relationship, if you like, between gold and fiat currencies. They have seen gold rise very substantially, certainly this year. And on that basis, they probably regard this as a bull market. They've got to get in and buy it. In other words, they're thinking like investors, which is actually a big, big mistake. But having said that, what we have seen recently, and certainly in the last few weeks, has been almost a global rush into small bullion bars, coins, and so on and so forth. The Perth Mint, for example, has run out of everything. They haven't got anything to sell. We've seen queues around the block in places like Thailand and Vietnam and so on and so forth. And in India, and this is an interesting one, in India, the psychology seems to have changed from, well, gold has gone up and it's too expensive, to I better buy some gold before it goes up even more. So this is a sort of short-term, perhaps, sign that it's a bit overdone, if you like, because these are inherently weak holders who are now rushing into it. But having said that, the big picture is absolutely clear. And that is that it's not a case of gold going up, silver going up, it's a case of currencies going down. And that's what you've got to keep focused on.
For investors seeking leverage to rising metals prices, mining stocks offer potential upside. But the path isn't simple. If energy costs climb, fuel and electricity expenses could squeeze profit margins. Higher spot prices may push miners to exploit lower-grade ore, increasing operating difficulty. Political risk and environmental regulation further shape outcome. Well-researched mining equities may outperform bullion during bull markets, but they also carry greater vulnerability during volatility. For those prioritizing stability over growth, physical gold and silver remain the preferred hedge. In uncertain times, the objective isn't just gaining wealth, it's ensuring you don't lose it.
Well, for investors, again, we're talking investors rather than getting into cash. I think mining stocks could make a lot of sense. You have to do your own research, obviously, but they probably provide a leveraged play on the back of that relationship between gold, silver, and fiat currencies. But it's not a straightforward story, because if energy prices start rising, and they have been very, very low recently, if they start rising, then the input costs for a mine are going to rise. And not only that, but the job of a mine manager is to manage cash flow. So higher prices basically means that a mine manager will go for lower grades. I mean, he's bound to. The idea that a rising gold price is going to lead to immense profitability for the mines, I would caution you in thinking that. It's not necessarily true. It's a slightly more complex picture.